G'day, my name's Robert Goudie and welcome to this week's video. This week we're going to have a chat about a question I've had over many years, and the perception that investors have that the price you pay for a share will have a huge impact on its future growth potential. And the thought process is that if you have a very low price share, 1 or 2 cents, then the chance of it going up is far greater than buying, say, CSL at $100, and the chance of it going up by the same amount is a lot less. And I wanted to really dispel those thoughts that there's really no correlation between the share price and the value of the business or the size of the business. So I'm essentially saying that share price is irrelevant. What is important is that there is growth opportunities for the business regardless of the share price. And just to show how irrelevant it is, if you can assume that you've got a business that's worth $1,000, you can have all these different variations. You can have, so a business worth $1,000 can have 1,000 shares worth $1 each. You can have 500 shares worth $2 each, or you can have 100,000 shares worth 1 cent each. But ultimately, the business itself is still worth $1,000. And its potential to grow, to grow in value or to go down in value is determined by how management look after the business and reinvest into their products and services over a long period of time. I think some good examples of this has been Berkshire Hathaway in the past, and I clearly remember back in the crash of 2009, the GFC, and looking at Berkshire Hathaway A-class shares. And their A-class shares have always been extremely expensive or highly valued. And back then there was a low of just over $78,000 US per share. And if I said to most people they'd say, oh gee, far too expensive, you could never purchase that, buying one share for 78,000 US dollars. If we roll the clock forward to today, and one A-class Berkshire Hathaway share is now worth 420,000 US dollars. Just because the share price has got more to do with the amount of shares on issue and the value of the business rather than its future growth potential, whether it can grow or not. Out of interest, Berkshire, Warren Buffett, Berkshire Hathaway's, that's the business that Warren Buffett runs, Berkshire Hathaway. They've been repurchasing their stock in the billions, and they've actually bought back using their capital, the business's cash, to buy back around a bit over 5% of the shares on issue in Berkshire Hathaway. That is, for shareholders, a very good thing, because it means that there's less shares to distribute dividends and profitability to, and therefore ultimately, if the business is still growing its revenue and profitability, then that is shared between less people, less shares. Just out of interest, Apple has been buying back shares for a number of years, and Warren Buffett's business, Berkshire Hathaway, purchased, just looking at my notes here, there's a fair few figures, $38 billion worth of Apple shares, and that was between 2016 and 2018. And then a few years later, Berkshire Hathaway sold about $11 billion worth. Now, the ownership of the business when they first put in their purchase was 5.2%. Then a few years later, they sold $11 billion, but their percentage ownership in Apple itself actually increased by 0.2 to 5.4%. And that was because that Apple had been constantly repurchasing back their own shares on an ongoing basis. So without Berkshire Hathaway buying more shares, they still increased the value. In fact, they sold some shares and their percentage value in Apple still increased. There's a lot of circumstances where businesses add new shares to the share registry, and that is where there's capital raise or share purchase plans where they're raising capital to further their business. Now in Australia, we see that all the time, particularly in small speculative businesses like mining businesses that are, drilling for gold or drilling for whatever. It takes money to do that, and generally they're unprofitable. So it takes more money to do that. So they're issuing new shares, generally at a discount to the current share price. And on the other hand, businesses like Apple and CSL, a great Australian business, have been buying back shares over a long period of time. Now, of course, we prefer the latter, where the businesses are buying back their own shares, and then hopefully the profit is still growing, and then there is more profit and dividends to share between less shares, which means greater growth for those remaining shareholders. So a bit of a long video. I hope that's a bit of a help and explanation that really share price actually doesn't matter, but the market value and its business's growth potential is what really matters. Thanks for listening. We'll catch you next week. Bye.